This is your technical update from the LMAX Exchange Research and Analytics Desk for Friday, December 4th, 2015. Euro dollar. So setbacks in the euro have been delayed for now after the market surged in Thursday trade all the way back up to the 38.2 fib retracement off of the August high to recent Thursday, December low move. At this point, though, overall the downtrend still remains firmly intact, and this rally should be very well capped despite the intense surge somewhere between the 38.2 fib retracement around 109.80 and the 50% fib retracement, which comes in around 111.20. Again, at this point, a lower top will be sought out over the coming sessions, with the downtrend still firmly intact despite this latest rally, in anticipation of the next downside extension and bearish continuation back below the Thursday low around 105.20 and down towards that March base at 104.60. At this point, only really back above 111.20 would compromise the immediate bearish outlook. Sterling dollar. So cable has been putting in a series of lower tops and lower lows since posting that 2015 high at 159.30, and despite this latest bounce, the market is expected to put in another lower top somewhere below this most recent lower top at 153.36 ahead of the next major downside extension back down towards a retest of that 2015 low at 145.66. At this point, only back above 153.36 would compromise this outlook. Dollar yen. So dollar yen has been chopping around over the past several days, with the market confined to a consolidation between 123.75 above and 122.20 below. A break on either end will now be required for clearer directional insight, with a push above 123.75 opening the door for a retest of the 2015 multi-year peak at 125.85, while a break back below 122.20 would open the door for a bearish down move towards an acceleration into the 120 area. Again, a break on either end is required for clearer directional insight. Euro Swiss. So nothing much from Euro Swiss over the past several days and weeks as the market continues to be confined to some sideways trade. Overall, though, the recovery remains intact off the yearly low and that record low, with the market being well supported ahead of 107 in favor of the next upside extension eventually back above the recent high from September at 110.50. Ultimately, only back below 107.14, that recent base, would compromise the recovery outlook for Euro Swiss. Aussie dollar. So despite the latest rally in the Australian dollar, the market has still been capped below that 73.82 high that we'd seen back in October, on the 12th of October. At this point, while the market holds below that 73.82 high on a close basis, deeper setbacks are favored, and the consolidation is classified as a bearish consolidation ahead of the next downside extension back towards the multi-year low, just shy of 69. Again, only a close below 73.82 would force a shift in this structure. Dollar CAD. So dollar CAD continues to consolidate off recent highs, and the market is trading just under that 11-year peak from September at 134.57. Fresh upside is favored above that 34.57 high, which would open a fresh extension towards the 140 area further up. Any setbacks should continue to be very well supported into the 130 area, while ultimately only back below some previous medium-term resistance now turn support in the 128 area would compromise the constructive outlook for dollar CAD. Kiwi dollar. So Kiwi has seen a bit of a bounce in recent trade, though overall the market is viewed as classified as a bearish consolidation ahead of what should be the next downtrend and a bearish continuation below the lows that we saw a few months back, those multi-year lows in the 62 area. At this point, a medium-term lower top is sought out in the 69 area, and only back above 69 would compromise the bearish outlook for Kiwi dollar. SPX 500. So the S&P 500 has been consolidating over the past several days since stalling out ahead of the record high from May, stalling out at 2117 ahead of that 2137 record high from May. At this point, there are signs of the market showing exhaustion and rolling back over, though we would need to see a break below 2003, that low from the 16th of November, to confirm and accelerate declines further, which would suggest the formation of a more significant top in this market. Inability to do so, followed by a break back above 2117, would open the door for a retest and break to fresh record highs. Gold. So gold has seen a bit of a bounce in recent trade, though overall the market has been locked in this downside pressure and this downtrend over the past several days, which has resulted in a break to fresh multi-year lows just below 1050. But again, so long as the market holds above 1050, there is risk of an oversold market showing a more significant bounce. We would need to see a break back above 1100 to officially alleviate immediate downside pressure, though this is a possibility again given the extended technical readings. However, if the downtrend continues and the market is unable to break back above 1100, this would put the focus on a test of major psychological barriers further down at 1000.